Lesson 18. Don't try to be a jack of all trades. Many investors try to get rich quick and invest in many different, very speculative investments. In this lesson, Bill O'Neill discusses why it is best to stick with one sound investment strategy and how you can maximize your investment returns by doing so. Why limit yourself to just good quality U.S. stocks? Plenty of other markets and investments seem to make some impressive moves.
When you first start investing, you hear about all types of intriguing opportunities to make huge profits. The list of booby traps includes foreign stocks, closed-end funds, low-price stocks, penny stocks, options, futures, gold, convertible bonds, junk bonds, tax-free securities, and real estate partnerships. There's also watching the stock ticker tape and listening for tips from the latest guest guru appearing on the daily TV stock market shows. My personal rule is always keep investing simple, basic, and easy to understand. Don't try to be a jack of all trades. No one can be highly successful speculating in penny Canadian mining issues and buying options and trading in futures and maneuvering in foreign stocks. The keys to success in investing and in life are concentration and focus. Greater risk of loss is the primary reason why new or relatively inexperienced investors should avoid most of the items mentioned above. Keep it simple. The U.S. has the greatest stock market in the world. There are more than 10,000 U.S. common stocks to choose from. If you can't learn how to profit investing in U.S. stocks, you aren't likely to profit in the commodity market or by buying foreign stocks. How much do you really know about a foreign government's political and economic policies, the soundness of its currency, or its accounting practices? Fools often rush in where wise people fear to tread. Many countries have a history of instability. Bernard Baruch, a well-known Wall Street speculator of years past, lost money investing in Mexico. Many of these same investment risks are still present in Mexico and South American countries. Russia and China always seem about to emerge as the next big capitalist expansion. Yet their unsound or less dependable government systems create enormous additional risks for investors. And of course, there exist varying levels of corruption in some foreign governments that many U.S. investors may not be aware of. I have always recommended avoiding foreign securities. Most individual investors simply do not know all they need to know about foreign countries. The risk associated with closed-end funds is that they often fall to a discount after the initial public offering and trade below their underlying value. Since their price is determined solely by supply and demand in the auction marketplace, there is no guarantee they will eventually sell at the price of their asset value. The discount will probably remain for years.
Why not buy low-priced stocks?
Low-price stocks, those selling for less than $15 a share, are usually cheap for a good reason. While it may be tempting to buy a lot of shares at a low price, the financial performance of most of these issues has been poor and lags most other stocks in the market. Do you want to put your hard-earned money into low-quality companies with deficient histories? Most institutional investors will not buy these types of stocks. Low-price stocks are often thinly traded and simply do not have the number of shares available in the marketplace to accommodate a big institution's need to make large dollar purchases. And, as we've discussed in this book, it's the big institutional investors that move a stock's price. The best stocks don't sell at $2, $4, or $6 a share. Fortunes have been lost in cheap stocks that have poor fundamentals. Penny stocks, which trade for under $1 or $2, can involve fraud. In addition, the difference between the bid and ask, the prices at which you buy and sell a stock, can be excessive. Imagine a penny stock costing 5/8 to buy and 1/2 to sell. Although an eighth of a point might not seem like a big spread, the stock would have to rise 20% before you could break even.
What about options and the futures market?
Stock options give investors the right to buy or sell shares of stock for a specified price by a certain time in the future. For example, if stock XYZ now trades at $50 a share and you believe it has real potential to go up, you might buy a call. That's an option to purchase, say, 100 shares of XYZ in the next 6 months at $55 a share. If it goes to $70 a share, you'll have a worthwhile profit on a smaller initial investment in the option. Options are risky because investors do not only have to be right about the direction of the stock, but also about the time frame in which they believe the price will go up or down. It's okay to buy stock options as long as you limit your option activity to 10% of your total investment dollars. But even then, options are more volatile and risky. Like stock options, futures trading involves contracts or agreements to buy or sell a particular physical commodity, grains, metals, energy products, or financial futures, interest rates, foreign currencies, or stock indices, at a specified price sometime in the future. Again, as with options, futures, due to their highly speculative nature, should be attempted only by people with several years of successful investment experience. People who have the get-rich-quick bug and commit a large percentage of their available money to options or futures are asking for trouble. They can suffer huge losses due to the extreme volatility, leverage using borrowed money, and time limits inherent in options and futures trading. The risks are substantially higher than in common stocks. Gold, to me, is a metal that has been overpriced for many years. It pays no dividend. Its appeal is based on fear. I prefer outstanding companies or, in poor markets, money market funds.
And bonds?
Convertible bonds, which can be exchanged for stock, are less liquid and can expose you to greater risk if you borrow heavily against them. As far as junk bonds go, they're just that, the lowest quality, riskiest bonds available. Because bonds are priced in relation to interest rates, you must ask yourself, how much training and experience do I have in buying bonds and assessing interest rates in the first place?
What about tax considerations?
You should make the best investment decision first, rather than place your first emphasis on taxes. I've seen people become so enamored with saving tax dollars that they get into a tax-saving investment that has poor returns. If you don't have the time to devote to buying and selling the best common stocks, I would suggest a diversified domestic growth stock fund and holding it for the long term. We will discuss investing in mutual funds later in this book. I know some people will disagree with my observations, but I do not like to take extra or unnecessary risks. Common stocks can be risky enough, and I can limit my risk in them by carefully selecting the better performers and having the discipline to always follow a set of sound selling rules. We will address selling rules in lessons 20 and 21 of this book. What's wrong with selecting good quality common stocks that are number one in their particular fields in sales and earnings growth in the last 3 years, and also have superior profit margins and higher ROE? You can pick stocks selling from $15 to $150 a share that are in strong industry groups and have good institutional sponsorship. The company should also have an excellent product or service, and its shares should be performing well. The U.S. really is the best place to invest, as long as you don't get the gambler's fever and try to get rich too fast. The keys to success: homework, concentration, and dedication. You can do it.
If you like the video, please click the like button below and subscribe to the channel. Summary: 1. When starting to invest, keep it simple. Only invest in domestic stocks or mutual funds. The more types of investments you own, the harder they are to keep track of. 2. You get what you pay for in the market. Low-priced stocks are usually cheap for a good reason. 3. Options are risky because investors do not only have to be right about the direction of the stock, but also about the time frame in which they believe the price will go up or down. 4. Futures, due to their highly speculative nature, should be attempted only by people with several years of successful investment experience.